Okay, further debate. I recognize a member from Stormont, Dundas, South Glengarry.
Thank you, Speaker. I will be sharing my time with my colleague, for the member from Lanark, Frontenac, Lennox, and Addington, a little later on in the debate. Bill 59, putting consumers first. Payday lending, collection reform, and home inspections have come before this House on numerous occasions during my tenures as critic of this portfolio, yet at last they seem to be reaching third reading stage. During the committee stage of the bill, we heard presentations and received written submissions from over 100 witnesses and organizations ranging from community advocates, municipalities, independent professionals, and from key stakeholders representing groups in industries as diverse as debt collections, real estate, home inspections, direct sales, and consumer law. Regulating consumer markets is always a difficult undertaking, especially in jurisdictions such as ours, where the principle of free enterprise and a commitment to consumer choice and service dictate the market's direction. Products and services and their delivery evolve on a daily basis. As legislators and stewards of the public interest, we are charged with ensuring we remain a competitive business environment with informed, empowered, and protected consumers. This latter characteristic of a good, stable, and fair market is desirable for reasons beyond simple idealism. The same powers and inventiveness of the human mind that have made our lives longer, easier, and more pleasant can and are often used to achieve just the opposite. No matter how many laws we pass in this chamber, and regardless of the avalanche of regulations filed by individual ministries, there's always someone who looks and often finds a way around them. When they don't find a way around the law itself, those unethical enough to engage in unfair practices against consumers are unlikely to be deterred from skirting the law and hoping to escape the punishment they deserve. The Ministry of Government and Consumer Services has a contact centre for consumers who are either looking for information about their rights with respect to a contract or agreement, and when they have a complaint against the business. Inquiry and complaint data is often used to justify legislative initiatives, including Bill 59's action on debt collection. You do not need to be a scientist to understand that good data collection and analysis can underpin a good argument and strengthen it. And bad data can sink any argument, even the best ones. Unfortunately, the data collected from the contact line is often not broken down into whether they were just requests for information or reports against the business, despite the obvious need to distinguish between an inquiry and a complaint. Most businesses respect the legal framework they operate in, meaning consumers who are dissatisfied with a product or service delivered legally and in compliance with the law don't have a cause for complaint, despite being rightly annoyed. Stakeholders, such as Receivables Management Association of Canada, were particularly concerned by the Ministry's use of inquiry data alone to substantiate an argument for greater regulation of debt collectors, and made it clear in their written submission. The Ministry had only published such a breakdown for the year of 2013, and I will come back to that in a moment. In 2009, the Auditor General of Ontario highlighted that consumer protection program run by the province needed improving. Firstly, consumers were unaware that the program existed, and they could turn to it for advice or enforcement. Secondly, lax enforcement practices meant that unethical businesses were not sufficiently deterred from continuing in the practice. In 2011, that review was followed up and the Ministry provided data about the increased communications for consumers and details of new advertising campaigns to promote awareness of the Ministry. Here is an excerpt from the Auditor's report. The Ministry also reports some improvement in its service volumes. It received 40,000 phone inquiries and 7,300 written complaints in 2010-2011, an increase of about 19% from 2009. This translates into less than one complaint for every 5 minutes to a ministry for the year 2010-11. It's no wonder stakeholders in regulated industries feel that the ministry is not addressing a genuine need to protect consumers, but chasing what they may turn to be a much less prominent issue. That proportion of complaints to inquiries did not change significantly in 2013, the year for which the ministry has made public a broken-down list of top inquiries and formal complaints. The highest proportion of formal complaints out of the total consumer contacts on a particular issue belong to home renovations, with 1 in 4 contacts being a formal complaint. Home furnishings follow close with 21%, water heaters 13%, appliances 17%, personal items 15%, phone plans, a federal matter, I would add 15%, collection agencies 12%, payday loans 6%, vehicle sales 6%, and vehicle repairs 1%. Now we go around, 1 in 6 inquiries to the minister is actually a complaint. Does the ministry take them seriously? It does not appear so. On the top 2013 top 10 list formal complaints, at least 617 belonged unquestionably to the Consumer Protection Act. This ministry's reason to be. I tabled an order paper question requesting data on the enforcement action under the Act since 2010 by year. In the year 2013, the number of formal complaints relevant to the Consumer Protection Act was at least 617. The number of formal complaints relevant to the ministry only opened 79 investigations, or about 1 for every 7 complaints. It's a game of odds that's not much in the consumer's favour. Call the ministry, and it's a 1 in 6 chance you'll actually get to make a complaint. When you do, there's only a 1 in 7 chance you'll even open up an investigation. You have better odds of buying a scratch card. The government's recent opinion polling bears out consumers' lack of satisfaction with the ministry. An opinion poll as recent as September 2016 revealed the following. However, those respondents aware of the Consumer Protection Ontario and who have used the Consumer Protection Ontario services aren't much more likely to view the ministry favourably. In response to my order paper question on updated consumer inquiry data, the Ministry of Consumer Services provided a table that showed that during most of 2015, the ministry received 3,000 inquiries regarding collection agencies, double the next worst offender category, but in line with the previous year's trends. If the Auditor General's findings are still current, that number would translate into approximately 500 actual complaints, close to the 2013 actual complaint data. The inquiry trend appears stable. The complaint one is likely stable as well. There is no province-wide emergency with debt collection running amok, just as the constant level of bother that demands a solution crafted with all due consideration and reflection. Debt collection inquiries are persistently high on the ministry's top 10 list because of the practices involved with pestering consumers to persuade them to pay up for a debt they likely owe. There is really no nice way to call up a consumer and order them to pay a debt, and there certainly isn't a way to do so without causing the consumer concern or annoyance. Being on the receiving end of collection action is a stressful situation for any consumer, which makes the industry a very common target for discontent. We were pleased to see Bill 59 address some current holes in the legislation protecting consumers who owe money by including some categories of debt buyers into the collection regulatory framework. Committee heard how corporations and individuals can rearrange a debt's ownership and structure to go after consumers, often without the necessary evidence or without the need to respect existing collection agency legislation. The PC caucus submitted some amendments to give all industry stakeholders clarity about which practices can be never tolerated, such as false reporting of payments, the buying and selling of debt that is beyond the statute of limitations, or taking collection action without the evidence to back it up. Consumers should know that there are both federal and provincial statutes of limitations for taking legal action with respect to a debt. When a debt has not been seen any payment or legal action for 4 years, it falls out of the statute of limitations and can't be used to initiate a legal pursuit against the consumer. It becomes truly bad and almost uncollectible. There are 2 ways to reset the clock. The consumer makes a payment towards the debt or acknowledges the debt in writing. Debt buyers who purchase old debt accounts that have fallen beyond the statute of limitations have a clear and pressing incentive to cause one of those 2 situations to occur. Unless the debt is acknowledged or partly paid, clearing the debt relies only on the consumer's willingness to settle the account and to be done with it. The committee heard first-hand evidence of practices unscrupulous debt buyers will engage in for the purpose of going after a bad debt they bought for a fraction of its total value. Debt and collection accounts and credit accounts can go into default for many reasons. Some consumers experience financial difficulties. Some consumers make genuine errors, such as not notifying a creditor of a move, or a tiny minority bail on the debt, knowing full well what they were doing. As the original creditor, you have a duty to your consumers or your customers to give them the benefit of the doubt and to work with them to regain compliance with credit terms. An out-of-limit debt means you, the original creditor, have never collected the money nor sued the consumer for more than 4 years. At the end of this period, offloading the bad debt or uncollectible debt is akin to selling rotten produce. You know nothing good can come of it, yet you do it anyway. We proposed an amendment that bans the sale of such rotten debts, making the original creditors responsible for the debt they have neglected to act on for years. The government side countered that these issues can already be addressed through the broad regulatory making power under the Collections and Debt Settlement Services Act. Then why haven't they? It's just another hole in this legislation. Regulation is a tool to hammer out fine details of the law's application and provide enough flexibility to respond to evolving market conditions. As an example, a provider of alternative financial services has found to be contravening the payday lending legislation by marketing the product as a line of credit. Despite owners and fast repayment schedules, it was a payday loan masked as something else. The government responded by amending a regulation defining payday loans to include products such as that particular one. Some existing practices are, however, so obviously unethical that there can be no argument for flexibility in banning them. There can be no excuse for fraudulent reporting of consumers' payments for the purpose of reactivating a consumer's legal liability for a loan. Nor can there be any permissive argument for being negligent in collecting evidence that the consumer owes a debt and you, the collector, have the right to demand payment. The government can acknowledge our concerns all they like, but will they actually take action to address them? Stakeholders from the collections industry also brought forward concerns regarding the absolute liability Bill 59 subjects them to without any due diligence defense. They cited a clear case study calling a consumer who was holidaying in another time zone at the time of a call. There would be no way to know, yet the agency would be absolutely liable and guilty of calling outside authorized hours. Sympathizing with collectors may be a challenge, but the government must see a fair argument when it is presented with one. During my lead remarks on this bill at second reading, I highlighted that payday lending and other such alternative financing products exist because of failure of conventional finance to serve all customers who would like to access such services. Conventional finance is a sort of low to moderate cost finance most of us are used to seeing and dealing with. We have seen bank accounts, credit cards, TFSAs, retirement and investment funds. Some have mortgages, line of credits, and personal loans at good rates. banks and other conventional finance institutions want to make money by giving us convenience and minimizing their risk. In order to qualify for credit products they offer, a consumer must prove they are a reliable borrower and capable of repaying the credit that institutions extend to him or her. That description fits far from all consumers. It leaves out some among other residents who are both the most vulnerable to financial strain and most in need of emergency access to cash when a sudden drop in income or a sudden expense or severe financial stress hits. New Canadians and those on stable or fixed incomes spring to mind immediately, as do the Ontarians whose prior bad credit record prevents them from accessing affordable credit products. Independent workers and the self-employed whose income is inconsistent by definition have a harder time proving credit worthiness than the consumers who receive a regular paycheck. Federally regulated banks and financial institutions often add fuel to this fire. Account fees that some banks charge can be over $10 a month, with additional charges for checks and debt transactions. Check holds make it so that receiving one's pay could mean another week's worth of waiting for the check to clear. Some accounts can require a minimum balance in the area of $2,000 to avoid being charged a monthly maintenance fee. When you're counting pennies at the end of the month, 2,000 idle dollars is a very distant prospect. Credit unions are part of the solution, as their cooperative and non-profit structure make it easier to accommodate those clients left in the lurch by a conventional banking system. Yet, clearly, not everyone is best served by a credit union either, or they would have already gone there for the financial needs. The question of financial literacy is incredibly tied to the payday lending by many of the government and third parties' side, to perpetuate a notion that if only consumers know how expensive payday lending or check cashing really was, they would go somewhere else. This is delusional. The demand for fast access to emergency cash is stubbornly there. The larger conventional finance players are either unwilling or unable to meet it. Debts and due bills cannot get wished away by consumers who see the doors to conventional finances shut in their face. In the end, that market must clear. Licensed payday lenders offer a way for this pent-up credit demand to be cleared legally, subject to clear laws and regulations laid down at the provincial level. They are the expensive but legal choice between that and the unregulated loan market, where the consumers could be placing themselves truly in harm's way. Unlike any other financial credit product, payday loans are not extended for long terms, and do not accrue interest, are not subject to credit checks, and tend to be cleared through a post-dated check given at the time of the loan. Staggered repayment schedules are routinely offered to consumers who, for one reason or another, can't come up with a full payment in one go. Whatever we do to this legislation, we must ensure that the legal, licensed avenue for consumers to get emergency cash remains open. Bill 59 and recent government action on the payday lending file point towards a potential reduction in supply to the provincial and municipal regulation. Let's begin with the rationale for Bill 59's changes in payday loaning. When we make laws, we should first study and legislate afterwards. In the most recent opinion polls, document dumped by the government on the day before the last long weekend, the Ministry of Consumer and Government Services revealed that it had hired consultant firm Deloitte to run consumer roundtables on the subject of payday lending. Fortunately for the ministry and the consumers, the study could hardly be of value. The two roundtables that were convened only attracted 16 participants in total, all drawn from the City of Toronto. I could not think of a less representative sample of the province of Ontario, save perhaps the caucus opposite. As with the majority Canadian population, most participants rated their financial literacy above their actual objective ability. were surprised at the actual cost of borrowing from a payday loan outlet compared to conventional finance tools, and expressed an interest in seeing more regulation on payday lending. This was followed up in 2015 with an online poll of 500 payday lending customers who showed that 60% of payday loan users have no way of reducing their expenses. Their budgets have been pared down to the bone. The Financial Consumer Agency of Canada did a bit more serious work on the issue and published a report in October 2016 titled Payday Loans and Market Trends. They surveyed 1,500 payday loan users in the spring of 2016 and crunched the data to give us a picture of the average payday loan borrower today and their reasons for borrowing from payday loan lenders. The data showed an average low to moderate income total of working age with little household savings who borrowed to cover an unexpected expense, such as a car repair or to avoid late charges, knowing that money would come shortly. Some users also reported needing payday loans to cover expected expenses such as utility bills, something this government's policies have made all more necessary throughout Ontario. Incidentally, respondents to the survey did not rate payday loans as their main option for accessing a hypothetical $500 rapidly. Only 11% said they would choose that route, while 24% said they would use their savings or emergency funds. Conventional finance had left these consumers without access to low credit tools. Only 35% had access to a credit card, while the Canadian average is 87%. Only 12% of the survey respondents said they had access to a line of credit, while the Canadian average is 40%. 90% stated that payday lending was the fastest and most convenient option for getting the credit they needed, while 74% stated it was the best option available to them. If these consumers could access credit at the same speed for less, whether through a credit card or a loan, they would do so. The FCAC identifies a clear scope for greater financial advice for users of payday loans. There is a positive correlation between seeking good financial advice and proper financial planning that may help break the reliance on payday loans. The agency notes that saving as little as $10 a week can amount to saving $520 over the course of a year. Given that the amount of an average payday loan in Canada, to help achieve the same, the PC caucus submitted an amendment that gave the government the powers to compel payday loan providers to refer borrowers to prescribed services such as credit counseling. We were pleased that the government side supported the amendment. It was one of just the two opposition proposals that were actually taken on board. A word about costs. The cost of payday loans is set directly by the government through regulations. It's been set at $21 for every $100 borrowed. For most of the time, the payday loans have been legal in Ontario. Recent changes have set a schedule for this cost to drop to $18 first and $15 thereafter. These gradual reductions bring the maximum allowable fee very close to the cost of doing business for payday lenders, leading some of the independent and smaller industry members to consider shutting down their operations. 1 in 10 payday loans go sour, and this is a very conservative estimate. In the ministry's own polling, the default rate averages between 17 and 45%. This rate is more than an order of magnitude higher than the loss provisions from a major financial institution. If a bank or financial institution had a 10% of its loan portfolio in default, the shareholders would riot, unless it had already gone bust. Considering how such a high proportion of non-performing loans over the short 2 weeks lifespan, it becomes clear that there is a fixed cost to payday lending that is significantly higher than the cost of providing secured or vetted credit. There are other costs beyond the $10 out of every 100 that will become non-performing. Payday lending locations need to pay rent, hydro, municipal and provincial licensing fees, security, staff costs, and the cost of capital, amongst others. The average cost of providing a payday loan was estimated back in 2004 to be around $14 by Ernst & Young, a consultant. As the cap drops closer to that amount, only the larger and most active payday lenders outlets can survive. As alternative to this political fee-setting mechanism could be the Financial Services Commission of Ontario. It's an independent regulator that combines enforcement with consumer protection through a transparent and objective fee-setting process for products such as insurance, including automobile insurance. The PC caucus suggested removing the politics and the payday lending fees and defer these decisions to the experts at Fiscal, who furthermore process much more enforcement and compliance tools than the Ministry of Consumer Services. The government said no. They adopted a Toronto-centric view that blinds them to the reality of life in smaller communities across Ontario. In my riding, smaller villages have lost their bank branches, and the same story is repeated across the province. It allows me to draw a parallel. Take any small community in Eastern Ontario with a bank and a convenience store. The store is privately owned ATM, which charges a heftier fee for cash withdrawals. Consumers choose the bank, obviously. With the closing of the bank branch, few consumers in the community prefer to pay the heftier fee than to go to the closest major urban centre and spend the money to attend the branch at that point. The government, seeking to be popular, imposes an arbitrary and low-cap fee on ATM fees. ATM located in cities and main thoroughfares will still be attractive enough for business and transaction fees to warrant their continued maintenance. Yet, what happens to those machines that are in the more seldom used areas, whose maintenance requires staff to travel over longer distances to collect or deposit cash to service machines that need repairs? How many of those will be actually taken out, leaving communities with nothing, forcing everybody to drive a distance for cash? The same argument goes for small payday lending outlets. Their lower customer traffic warrants special consideration, unless we want to price them out of the market. If the lowest possible fees are the goal, then an independent and more flexible fee settings framework is essential, for the financial realities of a business at Yonge Street are nowhere similar to the business in the village of 500 souls. The PC caucus, and I understand communities unease with the presence of payday lending businesses among them. They are a tangible reminder of both the market failure of conventional finance and the presence of financial strain amongst its residents. Yet targeting them or their business model does not cause the underlying problems to go away. It actually just makes them worse. As the availability of an in-person payday lending is likely to diminish, more consumers will turn to online lending for their immediate financial needs. Ontario licensed lenders have an online presence and can deliver services that way. However, the online market is pervaded by an unlicensed and foreign lenders who subscribe to none of our laws, none of our privacy guarantees, and really to hardly any ethical principle whatsoever. Anyone from any corner of the world can solicit Ontarians online. Unless our consumers are well educated about the need to verify a lender's registration with the Ministry of Consumer Services, they remain exposed to the risk of giving the keys to the finances to an unaccountable business that may have other motives to soliciting their information. Here's the result of a September 2016 opinion poll by the Ministry. It can hardly get any fresher. Less than a third of Ontarians know where to go for consumer information. Less than 1 in 5 are aware of the existence of Consumer Protection Ontario, even when they were told of the agency's name. Only GTA respondents report accessing Consumer Protection Ontario services. Those with incomes over $100,000 are more likely to know where to go to access CPO services, and are the only group to access CPO in the last year. They do not sound like the typical payday loan borrower to me. With this level of awareness and trust of the Ministry to go down the road on closing down payday lending outlets is just to invite even greater problems. The changes implemented by Bill 59 give municipalities the power to pass bylaws regulating how payday lenders are located within the municipal boundaries. The new provisions allow for bylaws specifying a minimum distance between payday lending locations and for the designation of certain areas where special rules or a ban would apply. Many municipalities have already put restrictions on extra costs of payday lending providers in an effort to curb the establishment. Our municipal partners will always find a supportive or sympathetic ear on this side of the House, and this issue is no exception. Our only concern with the legislation as written was the possibility of causing existing locations to fall foul to zoning rules that did not exist when they were opened. These are law-abiding and legitimate businesses that invested capital in creating an outlet, and it would be unfair to them or any other business owner to change the rules after the fact. We submitted an amendment to clarify that whatever rules were created under the new municipal laws would apply only to new payday lending locations only. The government's refusal to consider this change shows the intent to affect existing locations as well. This isn't the proper way to treat law-abiding businesses. However, uncomfortable we are with the model. Bill 59 was designed to have an effect on supply of payday loans to customers who need them, and it makes a double-pronged approach to ensure this aim is achieved. If payday lending locations survive the municipal zoning and shrinking revenue challenges, customers will see their access to this alternative finance curbed directly. During the second reading debate, as well as public statements on the matter, members of the government side described situations where consumers were able to access several payday loans at the same time, or in quick succession, following the repayment of an earlier loan. Providers are the first to say these customers are in need of good financial advice and credit counseling in order to get their budget on a more solid financial footing. Provisions of Bill 59 seek to ban the practice of rollover loans and to make accessing a second loan in a short period of time more difficult. Yet the legislation lacks the tools and the ability to enforce such a ban in a meaningful way. Consumers remain free to walk across the street to another lending outfit where their recent credit history with another lender will not be known. As long as the second lender uses in-house capital to extend the loan, rather than negotiate the amount with the network of providers and therefore act as a broker, no one will be any the wiser and the consumer took out the second loan. It is clear that the government's aim can only be achieved with the aid of a universal tracking system, such as the Payday Borrower Database. The Committee of Social Policy heard from the Information and Privacy Commissioner on the subject, who cautioned against the government-run system for that purpose. Information technology projects run by this government have a tendency to bloat their budgets, run late, and eventually release a product that is either obsolete or unusable, sometimes both. This leaves us with the option of a database built and administered by a private sector, as in the case with some American jurisdictions that have implemented such a scheme. Ontario's privacy legislation is strong, and I am confident the payday loan providers would create a solid and secure product if they had to. Without a mandate to participate in the database, however, lenders who use in-house capital would have no incentive to either join the database or verify a consumer's record against it. Bill 59 goes one step further in curbing access by setting maximum limits on payday loans available to consumers over several time periods. We submitted an amendment to take the cap on maximum payday loans in a year out, as it had made no sense to take the availability of emergency cash away from the customer, while doing nothing to alleviate the financial strain that caused the need for the payday loan in the first place. This government keeps asking itself the wrong questions on the issue of payday loans. The issue isn't how much. During the committee, we heard all kinds of proposals. $2.30 said the third party, $5 said a stakeholder, $21 says the business associations, 35% said another presenter. It isn't an issue of how many. There isn't an objective measure by which we can say that the set amount of payday loans in a year is okay for anyone. But one more is no longer okay. The question of where is not appropriate either. Consumers can walk to different locations, take transit, drive, or go online and borrow them from either a licensed lender or stumble across an unlicensed and an unaccountable one. By imposing a mandatory waiting period and giving themselves the flexibility to prescribe any time period they wish for, the government is shifting the debate to the question of when. Despite knowing very well that the consumer's financial stress and strain build up over time and can't be relieved simply by denying them the financial product that they actually need. Payday loans are not advice that we can simply bar people from or expect the problem to go away. The question we need to answer is why. But we know the government doesn't want to know the answer. Why do consumers experience financial strain? Our province has the highest proportion of minimum wage workers in Canada. When we used to be the hub of well-paid, stable manufacturing and innovation, anyone who has tried to pay for the necessities of life at exorbitant hydro on the minimum wage will likely confirm that it is borderline impossible and certainly allows no room for saving for a rainy day. Why do consumers require cash in such short notice? Because their jobs are precarious and life is full of surprises, often bad ones. Commuting to work requires a working car, and the breakdown could mean the loss of your family's income. Your next meal can't wait a week or 2 weeks, or however long the government determines the mandatory waiting period to be. Food and heat are needed right away and right now. Why are consumers unable to source such cash from conventional, unaffordable finance? Ask any new Canadian or person with bad credit or no credit history at all, and they'll tell you all you need to know. The dynamics of the credit market make it so that higher income, low-risk individuals get offered better perks for spending more money, while higher-risk consumers in need are left in the lurch. Secured cards require a deposit for the credit limited amount, when most families will likely fail to come up with that, with a spare $500 or $1,000 that they would have to keep locked away. It's the old adage about getting a loan once you prove you really don't need it. Last but not least, why is the government not tracking those root causes of consumers needing a payday loan? Because they know they've exacerbated the problem. We need to provide consumers with better tools to evaluate and plan their finances in order to help those who can budget some savings into their monthly spending to do so. For those who remain at risk of financial distress, we must work with both federally and provincially regulated financial institutions to help these consumers access affordable credit to address their needs. Allow me to quote from the summary of hearings, citing the presentation of Cardis, a think tank. Remove regulatory barriers standing in the way of civil society institutions like churches, mosques, synagogues, and community foundations, and financial institutions like credit unions. Local organizations are already seeing a growth in demand for assistance, mostly caused by skyrocketing hydro. Participants in poverty roundtables hosted by my colleague and the member from Lambton, Kent, Middlesex told stories of church benevolent funds going overdrawn as more and more parishioners have to turn somewhere for help with their hydro bills. Some turn to churches. When there's no money there, they might well have to turn to a payday loan outlet. Money has to come from somewhere, and the bills are due and they won't go away just because the consumer can't access cash. There are local resources that people instinctively turn to when they are in a bind. These can include the place of worship and often the United Way, the local food bank, and other charities. So let's work with them to figure out a sustainable way to help consumers in financial distress and prevent the need to ask a payday lender for money. The government and the third party may want to drive payday lending out of the province or making it impossible to operate or to do so profitably. We would rather see Ontarians prosper and succeed enough to see the payday lending demand actually dry up. Ever wonder where all the money went? The province drove Canadian economic development and attracted skilled workers and good jobs. Look no further than the party opposite. They managed to double the government's overall tax intake since they took office, while the economy didn't double in size. The more they took, the less there was for those who actually build their economy and prosper. Job creators, workers, savers. It's time to stop tinkering around the edges and blaming a problem on a symptom instead of a cause. Payday lending is not a problem. We need to redouble our efforts to tackle the underlying financial strain. This government chooses its courses of action depending on the popularity of the move, no doubt building its messaging for the 2018 election, hoping to cement its hold on the urban areas where there are many payday lenders. Bill 59 contains another government move that is likely to have little to no deterrent effect on bad players, but will certainly put law-abiding workers out of a job. Some door-to-door salesmen have been exploiting vulnerable Ontarians and consumers' lack of awareness of their rights to trick them into signing expensive and outright fraudulent agreements. These often involve a long-term lease, no early termination clause, or ridiculous expensive penalties for cancelling the contract. In some cases, consumers reported these agreements also cause liens to be placed against the real property by the company to guarantee its profits. The question of liens is particularly thorny, as most of the financial institutions extending the equipment credit are regulate federally and therefore do not respond to the Consumer Protection Act or similar provincial regulation. If you win against the company and get your contract cancelled in a provincial court, you have another fight in your hands to get rid of the lien. Something local legal professionals have shared with me as a source of untold frustration for consumers. The salespeople peddling these scams are neither law-abiding or ethical. I pose the following question to the government and those well-intentioned stakeholders who advocate for a ban on door-to-door sales. How likely is someone who is so morally bankrupt to take advantage of a vulnerable consumer to change their ways because the Ministry of Consumer Services filed a regulation on e-laws, a resource hardly known to the wider community beyond these walls and the legal profession? The answer is not at all likely. Bill 59 will allow the Minister to ban door-to-door sales on some products and services, which will cause good salesmen to lose jobs and unethical ones to find another product to tackle outrageously priced extras too. Consumers must be empowered to say no and to close the door whenever they feel like it, and never feel pressured to continue a conversation. They should be aware that it is now or never offer. It's probably a scam. Most of my constituents' complaints do not involve door-to-door salespeople, although I know other members' experiences vary. Especially in higher density areas, residents of Stormont, Dundas, and South Glengarry are much more frequently the target of fraudulent telemarketing. Their suspicions aroused, they call into our office asking if the government indeed called them or to offer a rebate or schedule a mandatory inspection. Of course they haven't, and we aren't always eager to highlight that if the consumer wants something done, the first port of call should be their utility, their phone book, or the Yellow Pages. Bans don't work unless people know they exist. Consumers know they can and will be enforced. Provisions of Bill 59 may create legal power for consumers to create recourse against a company that sold them a contract they should never have signed, yet the consumer must know they can contact the lawyer or the ministry for resolving the matter. We are still very distant from achieving that goal. The ministry appears focused on internet advertising, which may be economically more appealing, but it also is less likely to impact Ontarians who either don't use the internet or don't source as much information from it as they do from the local paper, local radio, or their TV. So let's not lead Ontario consumers into a false sense of security for a purpose of scoring political points. Day after a particular product is banned, bad sellers will still be out there scamming consumers anew. Local direct sellers who know their community and are committed to providing high-quality goods and friendly services will suffer. I wish now to turn my attention to Schedule 1 of the bill, which creates a new licensing regime for home inspectors in Ontario. I met with stakeholders and corresponded with several more regarding the legislation and have been seized by the issue even before the government convened its advisory panel in 2013. Home inspection regulation in Ontario is entirely voluntary. You can belong to an association and submit to rigorous testing and education, or you can choose not to. There are many independent home inspectors with a spotless track record of experience, whose services are valuable and reliable. Other home inspector licensing bodies, whether provincial or Canada-wide, provide education, professional development, networking, and a chance to be more visible to clients through tools such as member database services. When Bill 59 comes into force, the government will designate a corporation without share capital to act as a regulator, much like the model that we see with the TSSA, the ESA, the RICO, TICO, and the Bereavement Authority, and the Terran Warranty Corporation. PC Caucus and I have said for a long time that this government has allowed authorities to drift too far away from the government oversight and government leadership policy making. Industrial self-regulation is a useful tool to address matters that would be incredibly cumbersome to administer from ministry directly. For instance, the adoption of reference from Canadian and international equipment standards to the determination of safe practices in the electrical field. The government must, however, retain a strong oversight framework to ensure each agency works for consumers and manages the money it raises wisely. All delegated agencies should fall under this principle, including new regulatory authority for home inspectors. This has not happened, and it was only recently the government began incorporating a measure of oversight by the Auditor General and a half-member of salary disclosure at the delegated authorities in new legislation. I have crafted bills to bring this accountability principle to all delegated authorities, and I hope the government will take that on board. Now, I have more to say, but I'm going to turn it over to my colleague from Lanark and finish off the hour.
Thank you, Jim.
Thank you.